All right. Well, we may have additional people who join throughout the hour, so I may interject at various points just to remind people who join newly that we're recording. But I'll get started and just, again, thank you for joining us today. And I want to mention that my name is Joanne Kilgour. I'm the Executive Director of the Ohio River Valley Institute. We are a regional think tank providing sustainable solutions for a more prosperous Appalachia. And today we're releasing a new report titled Poor Economics for Virgin Plastics. Petrochemicals will not provide sustainable business opportunities in Appalachia. And we're very pleased to be joined by the authors of the report, Kathy Hipple and Ann Keller. So this report details how converging market forces are likely to impede petrochemical expansion in the Appalachia region, suggesting that alternative economic development strategies are needed to generate job growth and shared economic prosperity throughout this region. Environmental concerns are curtailing demand for petrochemical products. Under pressure, major petrochemical producers have pledged to reduce carbon emissions, shifting cost assumptions, and siting decisions. The Appalachian feedstock pool is limited, and market shifts in China and across Asia will undercut US cost margins. Those are just a few of the top line points, but we now have an opportunity to hear from our authors, Kathy and Ann, and afterward we'll provide an opportunity for questions and answers so that we can address any outstanding questions you may have. So at that time, we will open the floor, and we ask that if you have any questions, just type them into the Q&A or chat functions, and I'll moderate that session. So thank you again very much, and I'm now pleased to turn the mic over to Kathy Hipple.
Thank you, Joanne. Thank you, Ben. Thank you to my co-author, Ann Keller. We appreciate the opportunity to have dug in deeply to this research and the opportunity to be able to share our research with you and with others interested in economic development in the Appalachian region. So my interest in this subject has grown out of some longstanding interest about the oil and gas industry, and particularly the frackers in Appalachia. Currently, I'm a finance professor at Bard's MBA in Sustainability and a senior researcher here at the Ohio River Valley Institute, or ORVI. Over the last several months, I have been invited to attend discussions about economic development opportunities in Pennsylvania and the surrounding states. And I've noted that many advocates for the fossil fuel industry have been pushing for a petrochemical expansion throughout the Ohio River Valley. And often they cite very dated studies to support their arguments for such an expansion. So our research began with a simple question: is there currently an economic or financial case to be made for a petrochemical expansion or a petrochemical build-out in Appalachia? And we began with that question and really focused on the financials. And the report begins analyzing why the oil and gas industry, and specifically why the exploration and production companies, or frackers, in this region would advocate so strongly for a petrochemical expansion. We then zoomed out and looked at why the integrated oil and gas companies, or the whole fossil fuel industry, would advocate for a petrochemical expansion. And then we stepped even further back and explored the case from the perspective of petrochemical companies themselves, and specifically focusing on virgin plastics. So our research illustrated why natural gas producers in Appalachia are so eager to support a petrochemical expansion. Simply put, these natural gas and natural gas liquid producers, there's an abundant supply of gas and an abundant supply of ethane in the region. But the gas producers have limited opportunities to sell this gas and ethane, largely because access to market has become so constrained. This is primarily because new pipelines to transport the natural gas have either been delayed or in many cases completely canceled. So the natural gas producers are desperately looking for an opportunity to sell their product locally. And petrochemical plants would, in theory, give them a huge new market. And it's important to step back just a moment and realize that the frackers, especially the Appalachian gas producing frackers, are quite desperate from a financial standpoint. And it's very complicated because they've produced so much gas. There's been a production boom, but their financials have been bleak since the advent of fracking nearly a decade ago. Just recently, one of the gas producers in Appalachia declared bankruptcy yesterday, and joining 13 other gas producers in Appalachia that have filed for bankruptcy since 2015. The publicly traded frackers have recorded negative cash flows each year between 2011 and 2020, which means they've spent more money to drill for gas than they took in from selling natural gas. So I like to say the business case for fracking has never been proven. And so you say, well, what about this year? Because the gas prices have skyrocketed. And even this year in 2021, the companies have reported huge losses because of their companies' poor hedging strategies that have run amok. So the large oil majors, meanwhile, have a different set of issues. They have largely abandoned trying to produce natural gas in Appalachia. They've taken multi-billion-dollar impairments as they've pulled up stakes. This includes Chevron, this includes Exxon, this includes Shell. They basically abandoned this area and decided, except for Shell's cracker plant in Pennsylvania, the rest of them have stepped away from gas production and their fracking operations in that area. But the oil majors do remain focused on their petrochemical divisions. And the question is why? And looking into this, it's quite simple because as the gas and oil exploration production, their upstream, what we call their upstream portion of their business, as that has become less and less profitable over the past number of years, their petrochemical business has, in some cases, really carried them. And their refinery margins have also gotten squeezed. And in some years, especially when oil prices have been very low, it's been their petrochemical divisions that have created most of the returns in those years. So the return on the investment from the petrochemical division is seen as maybe the Hail Mary pass as the future prospects for the fossil fuel industry continue to dim. So our report then moves on to the interest of the frackers and the oil and gas industry. And those interests tend to be very short-term in nature. They're focused on quarterly profits and near-term fundamentals, whereas the petrochemical industry has got to be focused on 10, 20, 30, and even 40 years into the future. And so we've got essentially a duration mismatch between the interests of the feedstock producers, which is the natural gas and the ethane in particular, and the demands of the petrochemical industry. And so the petrochemical industry faces issues of its own, particularly in Appalachia. And with that, I will turn it over to my co-writer, Ann Keller, who has spent a great deal of time in the industry.
Thank you, Kathy. Thank you, Ben, and thank you, Joanne, and to everybody online. I appreciate your time and attention. My background is definitely embedded in the energy industry. I began my career with a producer on the E&P side, and over the years, I have also worked with the DuPont company, and am currently consulting in the industry, in the midstream industry. So I've done a number of projects in the industry and actually in Appalachia over the course of the last 15 years, where the industry has begun to step up and expand to the point where the Marcellus Utica region, of course, is the single largest natural gas producer in the United States. When we first started working on projects for the region, it was way back in 2007, I believe. And the goal was to support production growth because the companies were seeing the opportunities in the technology advancements in shale and believed that there was a lot of potential in the region to essentially revive the industry. But over the nearly 15 years where we've seen the growth in the industry, we've also learned a lot of things, as Kathy said, about what it takes to make the business profitable and how challenging that's actually become. And also how we've addressed the biggest challenge that the producers identified early on, which was called the ethane problem. They discovered that the gas in Appalachia is particularly rich in ethane, and that in order to continue to drill and to produce, they needed to find ways to remove the ethane from the gas stream so that the pipelines would accept the gas. And we looked for lots of different alternatives initially, including power generation for facilities within the region. But it became apparent that the volume was going to well exceed what we could handle with those applications. So the thought process turned toward the development of ethylene production, which is a desirable outlet for ethane. That's essentially the other market besides natural gas or power. And that was around, I think that was probably close to 10 years ago when a number of projects to use the ethylene in petrochemical production were proposed for Appalachia. I think at one time there were probably 5 or 6 projects in the works. And as you know, the one that actually did go into final investment decision and then ultimately construction was the Shell project in Monaca. And then another project that has been proposed by the Thai petrochemical company has been discussed and is still being put forward. What I was doing as part of this exercise was just to take a clean sheet of paper and say, now that we're 5 or 6 years along with all the changes that we've seen in both the natural gas and chemical industry, as well as the world at large, let's take out a clean sheet of paper and see whether it continues to make success to put another ethylene project in the Marcellus. And long story short, when you look at the report, what you see is that the ingredients that are needed to make what is actually a commodity chemicals facility profitable are primarily low-cost feedstock, high volume, and access to a market which is willing to cover your feedstock costs and return a profit and pay off your investment over a 15 to 20 year time horizon. And given that we see shale wells decline by 60% within the first year, that introduces an initial uncertainty right there, because we've discovered some issues that address sustainability. But beyond that, there were some significant changes in the economic profile that in Appalachia that I felt challenged the idea that we would need more petrochemical expansion in the region. The key issues, one, you need to assume a growth rate that will absorb your product into a global market for a long time. That outlook has changed a bit because the chemical companies' customers, who in this case are mostly packaging companies who make packaging for consumer goods, have said they want to see a lot of their product become reusable or recyclable. So the chemicals industry has already responded to that with a significant amount of investment in breaking down and repurposing plastic. So that, combined with the challenges that we're seeing in economies that don't want to see single-use plastics draped all over their beaches and hillsides, has reduced the potential estimate of demand growth in the so-called virgin chemicals production sector by as much as possibly 50% from the sources that we've seen. So instead of growing ahead of GDP to support economic growth, we expect the repurposed and recycled material to substitute for as much as half of that product, which significantly cuts the growth outlook for these companies. The other piece that was important, again, was revisiting the feedstock issue, because in the intervening 5 or 6 years between 2016, when a lot of the studies were done for new capacity, and today, the ethane problem has essentially been solved. Before, there were limited ways for producers to move ethane to market. And by now, what we've seen is 2 pipelines developed to move ethane to a market in Canada, 2 ethylene facilities there that are also expanding and will be bidding for the ethane supply from this region next year. We've seen not just 1, but eventually 3 new pipelines to the East Coast that will be used to increase ethane exports to other global markets, who, as we've seen, can definitely support price increases when you can ship your product to pretty much anywhere. We also have a pipeline that was repurposed and directed to the U.S. Gulf Coast, which has been used to support deliveries to that market, including to Shell facilities and storage locations that helped Shell be in a unique position to support producers by taking their ethane before the plant was built. That's a situation that's not necessarily available to companies who might be looking at ethylene plants in the future. In addition, Shell got a price subsidy from Pennsylvania, the equivalent at the time of roughly a 20 to 25% discount, as it were, on the cost of their feedstock, which put it in a very advantageous position as a commodity chemical producer. So when you stacked all of that up and took a look at it, the conclusion that you would reach is that a lot of circumstances have changed in the last few years. And you're looking at higher feedstock costs because ethane would now be capable of being sold into a global market to the highest bidder, including to Chinese facilities that have expanded their ethylene production capacity significantly in the last few years. You're looking at demand, which is increasingly uncertain because a lot of customers are pushing back on the use of virgin plastics in this critical packaging market. And again, when you look at, you're also looking at the outlook for feedstock production. And when we've taken into account the amount of high volume, relatively low ethane content gas, NGL content gas that's been developed and produced here, we've concluded that at best, production here might support the construction of 1 more plant, assuming that all the ethane was priced to remain in the region, which doesn't seem likely if you're bidding against all comers. So in short, when you take a look at everything that's changed and look at it from that point of view, and then layer in the issues that we've had lately with global trade, which have put some restrictions on our ability to compete in export markets in some locations with the excess ethylene that our industry might produce. We've decided that it's time to revisit the idea that ethylene production really has a home in Appalachia.
Thank you very much, Kathy and Anne. For those who may have joined after our introduction, just a quick reminder that we are recording. And we do have the opportunity to respond to any questions you may have. I have a couple of questions that have come in. Kathy and Anne, if you're all right with jumping into that, or I'm happy to give you some additional time to make comments before we go into the question phase. All right. Well, why don't we start with this first question, which is, are you concerned that the poor financial prospects outlined in the report will encourage investors to seek even more taxpayer subsidies?
Anne, do you want to handle this, or shall I give it a go? Or
well, I guess in terms of industrial development, if you know, is it, if the money is potentially offered, or if there's a program you could take advantage of, you know, naturally you're going to go for it. What I'm seeing, and I'm seeing this from the Gulf Coast, and you're much more familiar with it there, but what I see now is that the region seems to have more of a gas marketing or market access problem than it does an ethane market access problem. So I'm seeing proposals come out in the press for uses of a large amount of gas in regional projects, such as potentially hydrogen production or green ammonia or things like that. So I assume that those are partly subsidy driven. So, you know, that would probably be, I would say yes. And here in the Gulf Coast, I will say that probably the first thing that any industry development does, any developer does, is apply for immediate exemption to local property tax. So, Kathy?
I would agree with this. One of the things that we saw with PTTG, the Thai partly state-owned company, is that they did take advantage of state funds that were available, and many companies all over the world will take as much advantage as they can of federal subsidies and state subsidies. And one of the frustrating things is that you've got several states vying to get these kinds of companies to come to the region. And one of the points that we have looked at is several studies tend to inflate the number of potential jobs. We've seen multipliers that make no sense. One of the things in looking at the Shell cracker plant is that Shell has not always been as transparent about what the plant would cost to construct, how many jobs will be really at the end of the day, whether it's 400 or 500 or at most 600. It's a lot of money that the state of Pennsylvania offered for a very small number of permanent jobs. And so I think it's really important that people parse these numbers very closely and say, what is our state or what is our local area willing to give up in terms of having a relatively small number of permanent jobs? And keeping in mind that these are facilities that will last for decades in communities.
Thank you. The next question is regarding some of the policy assumptions that are underlying the report. So we've seen the oil and gas industry pretty easily pass state laws in places like Pennsylvania, banning city bans on plastics and electrification. Does that poke holes in the argument that the market for plastics, for virgin plastics, will go down?
I've seen those. I think you had one that was pending in Ohio, as a matter of fact. So again, I think that's the reason that we included the term virgin plastics in our commentary. We're not saying that demand for plastics is going to go away. We need these materials in our lifestyles. But when I was looking at the demand forecasts and revising them over the last year and a half, the bans were a piece of it, were a piece of the assumption, but a big piece of it was the decisions that the end users have made to go either 50% lower or 100% lower in their use of virgin plastic in their packaging. The important thing is, what do your customers want? So plastic bags are one thing, but the higher value and the more durable plastics are the other. And companies like Colgate and Procter & Gamble and, you know, the big folks, your toothpaste tubes, your, you know, your bottles for your detergent, those sorts of things, they're already saying we want a net 50% reduction in the use of new plastic in our products. And those are your customers talking, you know, regardless of what the public is deciding. The people buying the stuff in the stores are saying that, you know, that they just don't want to go that route. So that's really what's driving it, is the market. So, and regardless of what happens in some of our state and local markets, remember, this is a global market. And when these plants were built, the ethane feedstock made the output very competitive, and the target market for the excess polyethylene, which is what these facilities actually make, is global. So anything that wasn't able to be consumed locally, they were counting on being able to send into a world market at a cost competitive rate, because they were big plants, new plants using cheaper feedstock than the companies that were using crude oil. But if China and India, which are two of your biggest markets, are saying that they don't want that either, then your global demand picture is also reduced. So there's a lot of impact items there.
Go ahead, Kathy.
I think one of the other points to bring up is that the shell cracker plant, the intent was that for that to make a commodity plastic and not to make the specialty higher margin plastic, which is another thing we didn't touch on yet in this press conference. But this is will further put pressure on the financial case for any new petrochemical plants to be built there. And it's important to note that Shell really has dominated particular specialty chemicals, but it is not planning to make the specialty chemicals in that plant. It is planning only to make the, as you say, the commodity plastic or the commodity petrochemical.
The other point that we looked at when we started this exercise, like I said, looking at changes between 5 or 6 years ago when the efforts began and today and what might be different, one of the arguments that was put forward as a rationale to go ahead with a facility was that the reshoring idea, that we would produce more of things like medical plastics and specialties here, because we discovered during the pandemic, of course, that a lot of those amazingly were made overseas, or at least made overseas with material that came from here. But when we took a look at the composition of some of the more common medical supplies, like the housing for medical equipment or the tubing, or even the masks, the N95 masks, what we looked at when we decomposed all that was that the raw ingredients that go into those require more than just polyethylene. And the facilities here were designed to maximize consumption of ethane and produce a lot of ethylene, but to make those other products, you need ingredients that come from either propane, which is definitely not hard to sell in this region, or from refineries. Things like benzene, which is extremely carcinogenic and generally passed over the fence between a refinery and a chemical producer. Things like that are required to make some of these more durable, high-value items, and those really are not present here. So that was another barrier to siting facilities here.
Thank you. We have an additional question regarding sort of the current policy landscape, which is the bipartisan infrastructure bill outlines a significant amount of funding for two hydrogen hubs, two of which are supposed to be located in the large shale gas producing regions like Appalachia. Could the development of these hubs become an anchor for petrochemical growth? Or in other words, if ethylene production facilities make a lot of hydrogen, would having co-located storage and transportation be a benefit to them?
That I don't think would be a key driver for an ethylene plant. That's because you would have to get enough money for the hydrogen to make it worth your while to be here again. Hydrogen is considered a byproduct. You know, essentially, the ethylene plant says what is the cheapest pound of ethylene I can make in a plant somewhere around the world to be competitive. To do that, you figure out how much you're going to get for the ethylene, and then you credit the value of everything else that you sell against that to get your net cost per pound. So in the case of a hydrogen hub, you would have to be saying, whatever I have to do as a chemical plant to support the build out of the infrastructure to deal with the hydrogen, I would have to get enough back for the hydrogen to somehow add to the economics of my facility. And from what I'm hearing, the costs of producing hydrogen are still considered, or handling it, not necessarily producing it if it's a byproduct, but things like storing and piping it. From what I understand about the characteristics of hydrogen, the investment required initially in things like specialty steel and high pressure storage are very, very high. So it's hard to see how that works unless the hydrogen's converted to something like ammonia fuel or something like that. If you had some kind of a joint project, but something like that won't carry an ethylene production plant. That's a $9 to $10 billion investment to make.
Those are the questions that we have received so far. I do want to just take a moment and offer that if anyone else would like to add any questions to the chat or to the Q&A function, we'd be happy to address them here live. And if you'd prefer to have a follow-up conversation with any of our panelists or to review the report in more detail and then have a chance to ask some questions, we'd be happy to be available, and we will make this recording available. One additional question, the stock prices of fracking companies in Appalachia have gone up recently with the rise in oil and gas prices. Would you be willing to comment on this?
Yes, they have gone up. I think what we're seeing is tremendous volatility in gas and oil prices. And I think if you look at the long-term trend, one of the issues that Anne and I dealt with as we were putting this report together is that gas prices doubled or tripled in the United States. They've more than done that in Europe and in Asia. And oil prices are way up off of their bottom, and plastic prices have changed, and polyethylene. So we really had to go back to a blank piece of paper, as Anne put it several times, in creating this report to see if our thesis was still valid. One of the points about the fracking companies are that their stock prices have gone way up. But remember, they are still significantly lower than their highs of a number of years ago. And they are still constrained overall because they cannot sell their product beyond this immediate area. So many of them are starting to diversify beyond the Marcellus shale area. They're buying into other basins, for example, or they're merging, as Cabot has with a Permian producer. So I think that the reality is it's more of a trading play, and long-term investors, as many on this call may realize, I've been very involved in the fossil fuel divestment discussion over the years because of the poor long-term fundamentals of the sector. And I think there probably are going to be oil traders and gas traders making a lot of money over the time, but even these professionals at EQT, the largest gas producer in the country, often get their hedging strategies wrong, and they record huge losses in the billions of dollars. One of the producers just mentioned that they were going to have a $2 billion quarterly loss. Some forecast 5 billion losses over the year because they put these hedges in, which limit how much money they can make in the upside when prices go up. They're meant to protect them on the downside, but it's very hard sometimes to get those hedging strategies correct. So I would suggest if somebody's got nerves of steel and wants to be a day trader, get in there and play those fracking companies. But for long-term investors or pension funds, I don't think long-term, these are probably, I'm not a registered investment advisor, but I think that they have a lot of volatility that may or may not work for most investors. Does that answer your question, Reed?
Ironically, too, the inability to get a pipeline across to the coast to send everything offshore in LNG may turn out to be a blessing in disguise, because the outlook usually in the industry is grow, 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 maximize drilling, maximize production. But if the companies are taking a look at how to maximize profits, potentially scaling back so that you're able to manage within the infrastructure you have may ultimately turn out to be more profitable for them than the endless growth treadmill idea where you're just pumping capital in for, to keep drilling wells and support endless volume. And, like I said before, the challenge initially was not being able to sell your gas, even though you could get it into a pipeline because it had too much ethane in it. But now selling ethane, so they can decide how they want to manage their gas reserves. But again, like Kathy said, we see companies like Southwestern come in and then turn around and buy reserves in the Haynesville, because Haynesville's close to the LNG market, which is what everybody's targeting right now. So it's definitely riskier to be in this area.
And, one further question about that, based on what Anne just mentioned, is that the investors have gotten disgusted with this industry, that they were unable to produce positive cash flows. So the industry really has pulled back on their capital investments. And it's been a striking idea that these are frackers, not just in the Marcellus Utica basin, but also in the Permian. They've really scaled back because the investors said, show us that you actually know how to make money. And I think it's still an industry that's trying to figure out its business model long term. Hence the close scrutiny of maybe the Hail Mary path. I feel like this is a Hail Mary path, that maybe if we get petrochemicals plants, we will have a solution to our problem. But we think that that's a poor rationale for adding petrochemical plants.
Great. An additional question has come in. Would you comment on the increasing likelihood that A, Biden's climate policies will be severely curtailed by Congress, B, the Supreme Court could derail EPA's greenhouse gas authority, and both would argue in favor of continued use of fossil fuels through the rest of the decade and beyond?
I don't really see how we can avoid using fossil fuels, for some period of time. It isn't like a switch that you can turn off and on and magically have all your infrastructure show up like in virtual reality, unfortunately. So as far as commenting on what's going to happen with the climate policy, it's, heaven only knows. But I followed the methane regs a lot more closely than CO2, because the gas industry has been dealing with literally a tennis match between the Obama and the Trump administrations over some proposed methane regulations that have been outstanding literally for years, before this whole green ESG initiative even began. Over standardization of measurement, over concern about venting as opposed to flaring, because venting, of course, puts methane in the atmosphere, which is even more hazardous and more impactful than CO2 in the short term. So we're working with another round of notice of proposed rulemakings from the EPA right now on that score. For those particular regs surrounding methane, I actually see the regulatory process going forward, and I see some version of those going into effect before yet another topsy-turvy situation in DC. So methane is a subset of greenhouse gas. I realize that a lot of attention is focused on CO2 and whether or not we're going to have some sort of carbon tax or increased carbon credit to support those projects. That's the one that I think is definitely very, very dicey in terms of where, a group of 26 countries are going to come down on some common ground on how to handle that. I know the traders are, effectively chomping at the bit, saying, "Hey, we've kind of cut our teeth on low carbon fuels in California and RINs and things like that, and we're very excited about having something else to work with." But I think that one is still up in the air. So again, separating CO2 and methane, I think methane regs are going to tighten. You're going to have flyovers from the Environmental Defense Fund satellites that'll be publishing images on a routine basis next year that will highlight the so-called offenders, if you want to describe it as that. So I think you're going to see a lot of impact on the cost of mitigating flaring and venting. But as far as the rest of the whole greenhouse gas discussion, I don't really have an informed opinion.
I would just add that the whole idea of discussing methane emissions the dialogue has changed so much in the last 2 years. I think everybody was aware of CO2 emissions and greenhouse gas, but and I really credit some of the work with the cameras that people on the ground have done to really be able to bring this issue to light. And the idea that in Glasgow, this is a heavily discussed issue. And it's I think the narrative around the importance of getting a handle on methane emissions, that narrative has very much changed over the last 2 or 3 years from where I sit.
And in terms of discussions of job creation, I know that these grandiose multi-billion-dollar projects are very attractive from an economic development standpoint. As you all already know, they create lots of jobs for construction people who may or may not be from the area. That one is, you have better information than I have. But longer term, these facilities are largely automated, and they don't really create an enormous amount of permanent jobs. Whereas the issue of methane, as we've been talking about within the industry, this whole issue of mitigating methane, from everything from installing Bitcoin mines, which is going like crazy in where I am. It's considered to be a great way to scavenge up some of this vented gas that people couldn't figure out what to do with other than just let it go. So people are frantically working on that. There are a lot of small scale activities that can be done along those lines right now. Things like changing out valves, things like managing things at wellheads. Those sorts of activities and businesses create lots of jobs as opposed to a handful concentrated in one facility. You're talking about jobs in small communities. You're talking about jobs for a lot of people in skilled trades and work that will help us with the low-hanging fruit to actually mitigate greenhouse gas that's extremely potent that we need to get to work on while we argue over CO2 and the grand designs of global politics.
Kathy and Ann, just to follow up on that, I think something that is really important to note about the research that you've done here is that it is really looking at the financial picture without trying to project these assumptions about policy changes. And I think often when we're looking at the fossil fuel sector, we think about the interrelationship between policy or the legal landscape and the market. But what we continue to see is that the market conditions just are not supporting this kind of continued build out, even with this obstruction on action from Congress, and even with this potential new action by the Supreme Court. So I just want to make sure that that's an accurate characterization and that that's consistent with what you're seeing based on the numbers that you've looked at to produce this report.
Yeah, I think one of the things is it's really anywhere from an $8 to $10 billion investment. And the fact that other companies have come in and looked at this, Anne mentioned 5 or 6. We saw PTTG, the Thai company, look into this for years and years, threatening to issue a final investment decision, an FID, and they ultimately have backed away. They could not find a co-sponsor. The two they had have backed away. Exxon was rumored to be looking into doing this when they were spending $30 billion a year on capital expenditure. They said they're no longer interested in this. A Brazilian company was looking into this. And I think those are very strong market signals. If this was a great opportunity, especially with these states offering so many subsidies, somebody would have come in. And the fact that no one has is a tremendous market signal.
And the longer, and if people focus their attention on, if attention continues to be focused on one particular type of project as the one thing or something that's preferred or whatever, the more time that passes, the more that the reserves deplete, and the less likely it is that a big facility would be able to justify a decision. Whereas, broadening your view to other types of projects might produce some results quicker than hanging on to the hopes of the one.
Great. Well, thank you again to all of our attendees, and Kathy Hipple and Ann Keller, thank you both very much for your work on this report and for being here to present your findings and respond to questions. To anyone who's in attendance, feel free to reach out to us if we were not able to address your question. And thanks to Ben Hunkler from the Ohio River Valley Institute team, who's helped to facilitate this event today and has just put in a link with some additional resources. So again, we're very thankful for your participation. Thank you to our team, and looking forward to continuing this discussion over the coming weeks.